Hey everyone, I'm Dean, and welcome back to the channel where I break down the latest trends shaping real estate and smart investing. Today, I'm diving into a hot topic for 2025, how government policies and economic integration are transforming Canadian commercial real estate and what that means for investors like you. If you're curious about where the best opportunities are hiding, stick around. This is packed with actionable insights. Let's kick things off with the big picture. Over the last couple of years, the Canadian government rolled out its One Canadian Economy strategy. This plan is all about knocking down barriers between provinces, making it easier for goods, services, and most importantly, talent to move across the country. We're seeing simplified interprovincial trade rules, serious investments into innovation hubs, and those all-important economic corridors and big immigration reforms to attract skilled workers. Now, why does this matter for commercial real estate? Simple. When it's easier for businesses to expand across provinces, the demand for multi-use commercial buildings goes up. Toronto, Vancouver, Halifax, these cities are becoming super connected, not just locally but on a national scale. That connectivity is making them even more attractive for businesses and investors alike. Let's get into where the real action is. According to the 2025 Q2 Canadian CRE Investment Trends Report, we've got some clear frontrunners. Multi-unit residential is red hot right now. Cap rates have dropped, which means there's intense demand for apartment buildings and housing complexes. Industrial properties are also on the rise, especially as global supply chains shift and Canada positions itself as a manufacturing and export hub, partly thanks to ongoing US-China negotiations. Food-anchored retail, think grocery stores with other shops around them, remains pretty much bulletproof. On the flip side, office spaces are seeing higher cap rates. Investors are a bit more cautious here, putting their money into only the best locations. Now let's talk hot markets. Toronto and Vancouver are still the heavyweights. Investment volumes here have climbed steadily over the last year and a half. Toronto alone jumped from around $3.5 billion to almost $4.8 billion, not bad. But don't sleep on Halifax. This smaller market is exploding up about 67% since early 2024. Why? It's more affordable, has solid government support, and the regional economy is growing fast. If you're looking for stable growth outside the crowded big cities, Halifax is definitely worth a look. So how do government policies really shape your investment decisions? Here's my quick playbook. First, stay up to date on policy changes, especially around economic integration and immigration. These are reshaping where the jobs and growth are happening. Second, zero in on those economic corridors and innovation hubs the government is backing. That's where I see the best growth potential. Third, diversify. Focus on resilient asset classes like food-anchored retail, suburban multi-unit residential and industrial properties tied to trade and workforce demand. And finally, watch those interest rates. The Bank of Canada is holding at 2.75% right now, but any moves could impact your capital costs, so stay nimble. To wrap it up, government policies and economic integration aren't just news headlines. They're actively reshaping the Canadian commercial real estate landscape. If you embrace these changes and target resilient sectors in the right regions, you're set up to thrive in this evolving market. If you found this breakdown helpful, hit that like button and subscribe for more deep dives into real estate trends. Got a question or an experience in Canadian commercial real estate? Drop it in the comments. Reach out to me and the team today. Let us assist you in finding the ideal space for your venture, because a great location is the foundation of every successful business. Thanks for watching, and I'll catch you in the next one.